in a post-globalization or deteriorating globalization world, which is likely to have, higher inflation, higher pressure on commodity prices, et cetera. I think that's a real interesting story from a strategic perspective, where the vast majority of investors are totally unprepared for that, right? They're basically prepared for the next 40 years to be the same as the last 40 years.
Yep.
And it's very possible we see a totally different environment where there's persistent pressure, upward pressure on inflation, and higher levels of risk in the economy than what people saw before. So from a strategic perspective, it really draws you away from sort of traditional 60-40 to much more balanced, particularly holding diversified commodities.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. After decades of moving towards increased globalization, the aftermath of the supply chain vulnerabilities revealed by the COVID pandemic, as well as the geopolitical fallout from Russia's invasion of Ukraine, they're pushing the world order into a more fragmented state. If trade globalization has indeed peaked, what does that mean for the future of the major world economies and for asset prices? To address, we're fortunate to be joined today by Bob Elliott, former investment committee member at Bridgewater Associates and now CEO and CIO of the investment company Unlimited. Bob, thanks so much for joining us today.
Thanks for having me. Looking forward to it.
Hey, it's a real pleasure. Well, look, lots to talk about. I've seen some of your recent comments about post-peak globalization and really wanted to dig in that topic with you. Looking forward to doing that today. Before we get to that specific topic, I just want to kick this off with the usual question I ask my guests. What's your current assessment of the global economy and financial markets?
So in general, we're experiencing a pretty different macroeconomic cycle than most people have experienced over the course of their lifetime, whereas we've had a number of sort of bubble bust cycles and with them V-shaped recoveries. This cycle is a lot different because unlike the previous ones fueled by asset prices or by credit, the cycle that's going on today is an income-oriented cycle. It's driven by nominal wage growth, which is strong enough to support nominal spending growth, which is then driving continued expansion in the economy. And that sort of nominal income growth-driven cycle can be very persistent. There aren't a lot of unsustainable flows related to it the way that there typically is in a big credit boom or in a big asset price boom. And so the result has been that the cycle, particularly in the United States, has been longer and stronger than many people had expected. And as a function of that, what we've seen over and over again over the course of the last couple of years is that asset markets sort of keep pricing in an expectation of a swift shift to easing and economic weakness, particularly in the short rate and the bond rate the bond markets. But what has functionally occurred is the economy today basically looks about as strong as it has over the course of the last couple of years, and that continuously surprises to the upside relative to how folks are trading in the market. And that story is particularly true in the U.S., where growth is the strongest and some of the inflation pressures are the highest. But it's also true in many other developed economies where, we haven't quite gotten the significant deceleration which many folks had expected. And central banks also keep disappointing in other areas like the UK or Europe in terms of the pace in which they'll deliver the types of easing that is expected.
Okay. Question about that. So we've had relatively recently, three of the top 5 global economies slip into a technical recession. So can you balance that strength with the fact that we're seeing slowdowns in those countries? And to be specific, I think it's Germany, UK, and Japan are now all in technical recessions, right?
Well, I think when you're thinking about is a country in a recession or not, whether real GDP growth is positive or negative doesn't matter. When you're thinking about an economy, what you want to think about is how are economic conditions expanding relative to the underlying potential of the economy. And so if you look at an economy like Europe, the potential growth of the European economy is already zero. It's essentially zero, or maybe even a little weaker. Productivity growth has been zero for many years. The labor force there is contracting. And so zero growth in Europe is actually a totally fine outcome given their overall demographics. And as a simple example, if you go look at the unemployment rate in Europe, it is actually at secular lows. So while, talking about recession in Europe makes a lot of headlines, it's not a particularly relevant thing to be thinking about or focusing on, because the economy is growing about as well as it can given the underlying potential of it. And the same is basically true in the UK. Japan's a little softer, and is a bit of an outlier across the developed world, but the basic picture that you have these economies that are mostly fine against expectations that we're going to have a sharp deceleration, that's the basic picture. And Europe and the UK, they've been growing basically at zero for 2 years.
Okay, and so you're saying this time it's less asset asset price and credit expansion driven, and it's more nominal wage growth driven. I just had a sheet that had all these stats on it that I just literally tossed in the basket right before we sat down here. I wish I'd held on to it. But wages have been growing nominally in the U.S. I know less well other countries right now, but they haven't been for all that long, right? This has been sort of a response to the huge spike we saw in inflation, and the return to positive nominal growth in wages, if I'm remembering correctly, came after I don't know, I want to say 25 or more consecutive months of negative, certainly negative real wage growth. And I'm not sure if there was much positive nominal wage growth in that time period as well. You can correct me if you know better. But if you ask people since the inflation wave hit, I think it's something like 67% of respondents say my wages have not kept up with the pace of inflation. So I guess my question is how do we sort of square that where we had wages really at a disadvantage? Yeah, now they're beginning to recover a bit, but again, since inflation's coming down, and we're starting to see things like quits come down, and most of the job growth is in part-time jobs, which doesn't come with a lot of benefits and stuff otherwise. How short-lived might this spike in real nominal wage growth that we've seen, how sustainable is this, I guess is what I'm saying.
Well, I think the improvement in real wage growth that we've seen over the course of the last year or two is very sustainable. And that's the beautiful thing about wage growth, which is, one person's income is another, one person's spending is another person's income, which then turns into another person's spending. And it doesn't have the trail of liabilities that exists with credit. And it doesn't have the balance sheet risks that exist with an asset bubble, typically fueled by borrowing in order to inflate an asset bubble. And so, nominal wage growth in the U.S. has been quite strong. It, peaked at 6, 7, 8%, depending on how you want to measure it. For instance, the Atlanta Fed wage tracker peaked in that level. The initial, like any inflationary cycle, the initial response to the rise in prices was a lag until you got to the point where wages started to outpace inflation. But part of what happened there was the fiscal expansion and the transfer payments allowed people to dissave for a period of time and adjust their in order to keep their spending going during the period in which the wages adjusted. And at this point, wages have grown over the course of the last couple of years, roughly in line with prices, and now are starting to outpace price growth as wage growth remains kind of sticky at sort of 4 or 5%, depending on how you measure it. And price growth is kind of at 3, let's say. And that's a pretty good scenario overall for households to continue their spending. The main question is, what's the effect on companies? Because by its nature, the fact that real wage growth is positive, the flip side of that, of course, is that company profitability takes a drag. And so that's kind of the trade-off. As long as nominal GDP continues to grow at a fine pace, which it is at this point, the top line will matter more for those companies than the bottom line in terms of than the margins in terms of generating continued profitability. But that's really the tension point now. The tension point's to the businesses, not to the households. Households haven't been in this good a shape in a long time.
Okay, and I'm sorry I keep pulling into questions that I wanted to get in after we went into the peak globalization part of the discussion, but you keep mentioning these really relevant points. So help our viewers understand that, because we have a lot of experts on this program, and they have all sorts of different opinions. I would say, if I had to sort of create a consensus, I would say that a lot of them are kind of concerned actually about consumer households. And yes, it's good that wage growth has picked up, and that is helping. Like I said, though, a lot of households still feel like it's got a ways to go before they really feel like they've healed from this cost of living shock that they took on. But we've seen things like tremendous growth in, or let's say rapid growth in household debt, especially revolving credit. That's happening at a time where that credit is charging record rates. We're seeing, an explosion of participation in payment schemes like buy now, pay later and whatnot. A lot of people take these signs as signs that the consumer household is like increasingly, starting to struggle, right? And we just saw the retail sales numbers for January. It just came out, and I think it was the biggest year-over-year decline that we've seen in retail sales since like the early part of 2020, when we were shutting down the global economy. Now, that's just 1 month. That's not necessarily a trend yet, but people can certainly look at some of these data points and say, I don't know. It seems to me like the consumer is really beginning to get weak. And when you look at consumer sentiment, yeah, it's improving, but it's improving off of pretty low levels. When you say the consumer household is strong, what particular metrics are you looking at?
Well, I think it's important in this sort of circumstance to make sure that you're looking at a holistic picture of what's going on, rather than trying to pick particular pieces of information. There's always, in any macroeconomic environment, there's always a lot of cross-cutting information. In the past, if you go, over the past 20 years, it's been valuable to try and pick out the things that look like they're leading, because there is that self-reinforcing dynamic. But in an environment where, the post-COVID environment has created a lot of noise across a lot of different things, plus an elevated inflationary environment, means that you can get distracted by certain things when you're trying to pick out pieces rather than look at the whole. So, like, just responsive to the couple things that you brought up, consumer credit has risen as a percent of disposable income. It remains, at roughly the same levels as it was pre-COVID. Consumer credit, of course, is expanded in nominal terms because consumer credit is predominantly revolving credit card debt. That credit card debt, the vast majority in dollar terms, is paid off on a monthly basis by the borrowers on the credit cards. And so what you're seeing is nominal spending rising because inflation has risen, which means that the debts on revolving credit inevitably have to rise because the overall level of spending and charges on the accounts are rising. And so that's why you need to look at it relative to disposable income. Secondly, if you look at buy now, pay later, a lot of people get focused on that. Just for context, buy now, pay later, the amount of borrowing, the impact on GDP is equivalent to the GDP of Saginaw. Saginaw, who cares about Saginaw? Probably, 99% of the people watching this video probably can't even pick out Saginaw on a map, right? I come from Detroit, so I know where Saginaw is. But like, that's what we're talking about. Like, who spends their time talking about Saginaw, right? But that is the reality of what people are doing when they start to talk about buy now, pay later, right? That's how big that is. It added like tenths, like tiny, basis points onto GDP because it is so small. But yet people are talking about it because it's a shiny thing that looks bad rather than quantifying it. And that's why it's so important. You have to quantify these points. It's not, there's some stress in one corner, some stress in another, therefore the whole system's going to come down. What's going on with the vast majority of households? With secularly low unemployment, their incomes are growing at 5% nominally. They have bought houses that they financed at between 2 and 3%. Those house prices up 40%, and their stocks are surging making their 401ks as as good a shape as they've been in a long time. Like that's what's going on. And the result is that these households are spending their nominal incomes and creating real spending power. And so, that's the aggregate picture. That's the picture for the median household. If 65% of households own their own home, 65% of households own stocks. Like if you own stocks and you own your home and you have a 2% mortgage and you're one of the 97% of folks out there in the labor market that are employed and your wages are growing at 5%, like it hasn't been better than this in a long time.
Okay. All right. That's a great list of things to be looking at here. I've got maybe one or two questions and to dig into that stuff, but I don't want to detract us anymore from the main event. So maybe we'll get back to some of this stuff in a moment. But it's very helpful context, and you don't let me put words in your mouth, but it sounds like you're pretty sanguine about at least the U.S. economy looking forward here for what, rest of the year, couple of years?
Well, any humble macro person will recognize that the foresight is in at least on a cyclical basis is in sort of the 3 to 6 month range. What's going to happen 9 months from now? You don't want to get over your skis on that. A lot of things could change. So, I think when we look at the picture, in particular to kick off the first half of the year, and that connects to whether the Fed's going to cut, et cetera, it looks like the economy has a fair amount of momentum in place to continue to expand in a way that shouldn't lead to too much in the way of needing significant monetary policy easing. Looking a lot further beyond then just becomes less and less, more and more uncertain.
Okay. So let me put it this way. You feel pretty sanguine right now, and until and such time as you come back on this program and tell us,
Right.
I'm starting to see things that worry me, you're feeling pretty good.
That's right. I'll send you an email when things are not looking good.
All right, great. Okay, so to the main question here. So this question about peak globalization and maybe is it already in our rearview mirror? I noticed this initially in a tweet that you put out on Twitter or X or whatever it's called now. And maybe if you can just give a little backstory to the data set that you were looking at there. We have had periods in the past where we've shifted from a more globalized economy to a lesser one. So it's not like this has never happened, but certainly globalization's been a really big trend for most living people. I mean, most folks watching this video, that's kind of all they've known has been increasing globalization. If that trend is truly starting to plateau and perhaps start reversing, what implications is that going to have?
Well, I think let me pull up the chart if you'll bear with me, because I think it's a good chart. Can you see this?
Yep.
I think it's a great. This was great context over a 200-year time frame. Like, what have we experienced? Most of us, and what the chart is the amount of trade that has occurred, as a percent of the global economy, and so measured as total imports as a percent of GDP. Reflected by adding up all the countries based upon their population, right? So take all the countries. Population, weight them, imports as a percent of GDP. And what you see here is relative to history, we've got one of the biggest, basically the most global trade we've ever had in the last 150 years, which is not that surprising, in particular since we've brought on over the course of the last 50 years a huge number of different economies into the global mix. First, Japan and Asia, and then China coming after that. And so basically everyone alive today only knows this post-war surge in global production integration that you see, starting in 1945 and basically rising until the financial crisis and really just after, all the way to COVID. And that's a really important dynamic. But it is, because what it did is it increased a lot of efficiency. It was a downward pressure on prices. It was a significant pressure on the middle class of particularly the expensive developed world in terms of their wages, and basically just created a ton of efficiency in the economy. I mean, today, like maybe not today, but if you go back 5 or 10 years, basically every good and almost every service was basically either built or done in the most efficient place in the world, where the productivity adjusted cost of that labor to get that service or good done was the lowest possible cost everywhere. And that that getting to a peak in that and then possibly reversing that creates a radically different dynamic than basically anyone's experienced. But it's not that unusual in sort of a global economy sort of sense to have these sorts of ebbs and flows, from the post-World War I through World War II environment, a lot of isolationism, a big drop. You had the UK dynamic, when the UK became the global leader, you had a big expansion of global trade. And as they trailed off, that also faded. So it's not like these things are certain. I think many of us sort of take for granted that, trade globalization is the reality forever. And it's definitely not necessarily the case.
Okay. So, world woke up after COVID and said, all right, we had these hyper efficient supply chains, but the cost there is resiliency in case a monkey wrench gets thrown into the gears, right? Boy, it probably makes sense for us both from an economic security standpoint, but in certain cases from a national security standpoint, to bring some of those home, right? So we've got a lot of money flowing into building infrastructure here in the U.S. to try to reshore or friendshore, some of those supply chains. Then, of course, Russia invaded Ukraine. America sort of, weaponized its financial system against Russia. Not saying whether that was the right or the wrong thing to do, but it certainly sent a message to other countries that, like, wow, I'm maybe not America's bad side today, but I could be tomorrow, and I don't want to be completely vulnerable to that. At the same time, and we can debate what the reasons for this is, but I think you're seeing a rise of nationalism in a lot of places around the world. Europe, I think, is a good example right now, where we're just seeing more populist candidates, getting elected at the top of the political pyramid. And so it seems like there's a lot of seeds being laid for this rolling over of the chart that you just had there, right? Where we could see less and less trade being, percent globalization going forward. I guess first, do you believe that those seeds I mentioned are ones that are going to actually create that future? And if they do, what does that look like? I mean, you can maybe make some pretty easy bets, like, okay, that's probably going to have more secular inflation in it, just because the cost structure is going to be rising, at least in the developed world, as we do that. But what other knock-on effects would you expect to see?
Well, I think for a lot of folks, the impact of this shift from essentially optimized production across the world to parallel production across the world has will in many ways sort of very clearly have that inflation effect. But what I'd emphasize is that the sort of short to medium term effect of that is actually growth positive, which is very interesting. And it's globally growth positive, because essentially what we're going to do over the course of the next 5 or 10 years is, in each one of these different economic blocks, create parallel infrastructure, production and services infrastructure that didn't previously exist. And so if you think about it, the t-shirt manufacturing that once was basically in the US, then went abroad to Southeast Asia, now gets replicated. Maybe it's not in the US, maybe it's in lower income areas of the US or in Mexico or in the rest of Latin America. But that's just that building that infrastructure requires investment. That investment is a positive impulse on overall demand, which is actually in the short term a bigger impact on the inflationary dynamics than actually the shift in the goods production, because what it does, the actual investment has a levered effect on economic activity and happens today, not over the course of the whole productive capacity. And so that's like in the U.S. context in particular, what we're seeing is things like the CHIPS Act and infrastructure and stuff like
Right.
that, which are directly responsive to this dynamic, creating a lot of strength that would have otherwise not occurred. So I think that's really the first stage, and particularly important in the context of these economies that have had an inflation problem recently and are already operating at, late cycle, relatively tight environments.
Okay, so that's growth positive. It's a short-term stimulus, right?
It's a big short-term stimulus, which I think it's easy to sort of skip over that fact that, oh, well, this is inflationary and that's kind of it. It's like, no, the first thing is it's growth stimulative, then it's inflationary as production capacity shifts to essentially onshore or close shore supply relative to offshore supply. And then, the other thing we should talk about and reflect on is it's beneficial. There's big winners and big losers on that, which is the folks who had, the countries and ecosystems that had their productive capacity hollowed out,
right,
and the groups in these economies that had been outcompeted by, global supply of labor that came on from farm to factory. Those folks are going to actually, see a marginal benefit, whereas those who are so reliant on the internationalization, and that is particularly China, but also, India and other places in South Asia that were very reliant on the plugging into the globalization pipeline, those folks are going to see a real detriment to their ability to continue to see the type of growth that they saw before.
Okay, so yes, don't know exactly how much yet, but some material percentage of global commerce flow that was going into their coffers is not going to go there anymore, and it's obviously going to impact them pretty strongly. Let's talk about the states for a second. So if I understand you correctly, I remember when was it, 92? Was that Ross Perot and the giant sucking sound, right, of jobs that we're going to hear, because of NAFTA, and then of course you're talking more on a global scale, where we sucked all these jobs, largely sort of middle class jobs, off to other countries, production jobs, et cetera, because they could be done, as you said, on a much cheaper basis there. How beneficial do you think this could be to the middle class? Is this really good news for the American middle class? Because the middle class has been getting pretty beaten up for a good while, and I think if you talk to folks in the middle class right now, they almost kind of feel like an endangered species. And maybe I'm using a little bit of hyperbole there, but that's what I feel. Is this something for them to really cheer going forward? Is this going to make a material difference to the prospects of the middle class in America?
Well, I think for cohorts that are, have seen a significant decline in their labor opportunities, the onshoring of productive capacity is, a pretty good, it's a pretty important positive for those areas. And I think in particular, as you start to look at where, in the U.S. context, where are the most attractive opportunities to start to build this infrastructure is, in places that you're not going to build this infrastructure, within 100 miles of New York City because it's going to be too expensive. Instead, you're going to build it in the fallow fields of, forgotten Detroit or Cleveland and Saginaw, right? Or Flint. That's right. You're getting, we'll see how many Michigan references we can make in this particular conversation. But I think for those areas, what they provide is they actually provide, there are, the people who have continued to engage in manufacturing production, just very, very high skilled manufacturing production, are still around in those areas. And so you have a lot of capability, a lot of expertise in terms of how to set these things up, build them, et cetera. But what hasn't happened is it hasn't drawn in the additional free labor in those areas that's much cheaper today than it was in the past. And so I think that can create, how are we going to how is the U.S. going to significantly support incomes of those who don't have college degrees? I think it's going to be through this infrastructure process, first building the buildings and then staffing the buildings that are doing the manufacturing capacity. And so that's going to be a real benefit for maybe not the middle class. And I probably distinguish it because I think there's other things going on with sort of the educated middle class, the white collar worker. But for the blue collar worker, this may be one of the better 10 or 20 years that has been in place relative to the last 50 years.
Okay, well, that's something to cheer. How much, and I'm probably asking you to speculate unfairly here. I just don't know, and I'm curious. What do you think the folks that are deciding to do this, right, at the corporate boardrooms and maybe, with the influence of folks in Washington, how much do you think they're trying to reshore here? Is it like hey, we're not going to reshore everything because that's just not cost effective. We'll still work with these guys internationally. We're just going to work with them not as much, and we're going to have enough critical capacity here so that if we have another global pandemic type thing, we're going to have some domestic supply that we can scale up. And we already have the infrastructure and the knowledge and stuff on how to do that. It's a lot easier to go from 5% production to 15% or 20% production than it is to go from zero production to anything, right? And so how much of it is sort of like that, where it's sort of like it's like a minority stake in the production ecosystem, but it's one that you could scale up if you had to, or is it more than that? Is it like, hey, we're just going to keep trying to do this, and turn the clock backwards and see how far we can go?
Yeah, well, I think it in some ways is going to come down to what the policy framework is that that's going to exist for the U.S. I think the U.S. in particular, but other developed economies.
Mm-hmm.
If you just take, for instance, something like putting 60% tariffs on China, which is a proposed policy, or at least a talked about policy from one of the presidential candidates, that type of magnitude of tariff policy essentially totally changes the economics of onshore versus offshore production, or nearshore versus far offshore production. And so you could, if you go back to the chart I was showing before, we went from a period of time where something like 15% of GDP was in some sort of tradable structure in one form or another to about 30-35%. There's no reason why we couldn't go back to 15%, let's say, something back to sort of the average, pre-post World War II, in an isolationist environment. I'm not saying that necessarily that's a certainty that we're going to go there. Just saying, if you're thinking about what this could look like in a sort of, let's call it a maxi isolationist environment, you could get to something that looks in that order of magnitude, particularly on a blocks perspective. So maybe not USA in particular, but like US, Canada, Mexico as a block, or Western Hemisphere as a block. That would mean moving 15% of GDP essentially of, global activity, basically duplicating something like, 15% of GDP of global activity in one form or another. If that happens over the course of 10 or 20 years, even 10 or 20 years would be a meaningful impact on economic conditions for the investor, the people building the capacity, and would be a meaningful detriment in terms of no new capacity build for the folks who are feeling the pain from the unwind of the globalization trend. So that's a dynamic that could be meaningfully supportive to a U.S. economy. And I should say it happens in an environment where we're also having these demographic challenges. And so you have lower or falling supply of labor, need to reshore, need to build parallel infrastructure. That combination of things is pretty challenging when it comes to thinking about how are we going to move and build, and plus the skill loss that's happened over the last 40 years in terms of literally doing it. Like, putting that all together is a pretty challenging task if we're going to really decouple from each other.
Yeah, and let me continue my U.S. centric line of questioning here, because this conversation comes just a few days after I had one with a demographer, really getting into the challenges that I mean, it's rampant across much of the world now. I mean, really, except for Africa, most countries are on track to basically start entering some form of population decline in the next couple of decades. Um, and they're all aging as well. So the key productive age cohort of 25 to 54-year-olds is already shrinking in almost any country you and I can name, except for Africa. Um, so it sounds like part of the recipe for success going forward for countries is going to be who can attract and grow that cohort. You know, if you can do it internally, great. But if not, what's your supply of new people who are going to be, filling that need of younger productive workers? And I guess I want to sort of connect that to your comment there about, I guess, trading blocks, right? Where we've seen a lot in the headlines over the past couple of years about the rise of the BRICS, and a lot of postulation that the unipolar world is now becoming at least bipolar, and who knows, maybe they might create their own competing currency and all that stuff. I don't want to get into that, but I guess in your study of this so far, what do you think is the likelihood that we will fragment into trading blocks, where it'll be America? I don't know who they are, but I'm sure we'll still keep a lot of our Atlantic alliances, and maybe get even closer to Latin and South America, because that can be a source of younger workers for us, and then have the rest of the world try to rotate around seems to be the emerging BRICS axis.
Yeah, well, I think the story is probably a little different between the different major blocks. When you look at the U.S., the obvious place to turn, which has the combination of geographic proximity, similar enough value structure and corporate structure, and strong, pretty well educated labor force growth, is for the U.S. to really turn first to Mexico, which of course we've done for 25 years, but then also turn to the rest of Latin America.
Mm-hmm.
And I think that's really, from the U.S. perspective, I could easily see a transition here from a NAFTA block to a Western Hemisphere block being
Mm-hmm.
the primary economic engine, which is interesting because a lot of the talk with the BRICS is like the intersection between, say, Brazil and China. And, if anything, it seems like this shift to a less integrated world is more likely to sort of break that rather than support that relationship, given the geographic proximity, as well as, and I should emphasize, the capital flows dynamic as well. And so that also, we've talked a lot about trade and production and things like
Yep.
that. That is also another very important dynamic here, because when you go through a period where you're going to have to rebuild so much infrastructure, the places that are going to be able to do that most effectively are the places that have the deepest, most effective capital markets,
Yeah.
right?
Mm-hmm.
And access to capital. And so, we know, the U.S. and the U.S. dollar is a huge liquid capital market with tons of skill in terms of allocating it, particularly to emerging economies, whereas other groups like China have proven certainly to struggle to some extent in doing that access to global, or providing global capital in a way that is at least economic in nature. They've been proven to be able to do it in a non-economic way through Belt and Road, but not really in an economic way that over time is gonna really pay the dividends the way that the Western and particularly U.S. capital markets have become very effective in.
All right, so just kind of connecting the dots from what you're saying here, I take it that there are definitely points of view out there that say, look, U.S. has had a great ride, but it's got a lot of problems, and its best days are behind it, and whether we want to talk about its debt burden or the erosion of the middle class, or there's the whole litany of things we could go through to say, okay, this is the list of reasons to be concerned. But with your broad brushstrokes, I'm sort of hearing a different story, which is, hey, the next couple of years may actually be pretty good in the U.S. and a number of other places because of this short-term stimulus from all the infrastructure spending and stuff like that. But also, when we look at kind of who's positioned well for a potentially post-peak globalization world, the U.S. has got a lot of strengths going for it that a lot of other countries on the chessboard, and even a lot of other big ones on the chessboard, and China, et cetera, don't have. So are you pretty sanguine about the opportunities for the U.S. economy from here? Knowing there are going to be bumps along the road, but
yeah, I mean, I think my mind is I'm reminded as a kid growing up in Detroit in right around 1990, we there's the question of which sort of languages were you going to learn in school, in elementary school and middle school. And at the time, we all had to learn Japanese because at the time, everyone had penciled out that the Japanese, particularly in the auto industry, were going to take over the global auto industry. And, the U.S. was going to be beat, and we needed to get on board and be prepared for that situation. And what we saw over the course of, while I was learning Japanese, the U.S. economy was having the single greatest period of 10 years of the last 100. And Japan had a terrible outcome because of a combination of demographic and debt-related issues. And, I don't want to extrapolate one place to another, but it certainly all of the tales of China taking over everything in the world and being the great superpower certainly reminded me of the feeling in Detroit as a kid in 1990 learning Japanese when I was hearing all of those tales over the course of the last 10 years. And so, these things don't they seem very obvious at the time that there's going to be one obvious winner and one obvious loser. When, I think what's been proven by the US over the course of the last 75 or 100 years is, a resilience to be able to reinvent and recreate and lead over and over again, despite the challenges of a variety of different powers that have threatened it. And so, yeah, I think there's a lot of stuff. There's a lot of things in place for the U.S. to maybe not be the sole leader or the only leader the way it was sort of in the post-war period, but to be, the best amongst the opportunities that are out there over the course of the next 10 or 20 years.
Okay, so thank you. This has been a super fascinating discussion, and it's great to hear some of these fundamental reasons for long-term optimism, which is great. Let's translate this now into what you do on a day-to-day basis, right? Which is figure out how to manage investor capital for the future you see ahead. And in theory, at least, the economy and the markets should be connected to one another, but they're not the same thing. And I'm curious to get a sense for, given kind of the macro outlook you've shared with us, kind of how what kind of investing strategy you've put together. But I also just wanted to give a nod too to the fact that, you said this wasn't an asset price driven expansion, but asset prices are doing pretty well right now. Animal spirits are running pretty high. We're back into margin expansion. We have a market that's got really narrow breadth right now, and so one can make the argument that asset prices, could be excessive, at least relative to fundamentals in this current market. I wonder if you feel the same, and how that might be impacting your investing right now.
Well, I think I'd probably separate two things. A lot of what we talked about related to sort of the secular trend the possible secular trend to deglobalization is really the sort of thing to start to think about for your strategic portfolio rather than tactical bets.
Absolutely. And so that stuff's going to play out over decades.
Going to play out over decades. I think the thing that's interesting about that is that a lot of people, in terms of their structural predisposition, in terms of where they would typically allocate capital, it's been very oriented around strong growth, low inflation. That's basic, which has been a great trade for the last 30 or 40 years of global integration. And what we see here, in a post-globalization or deteriorating globalization world, which is likely to have, higher inflation, higher pressure on commodity prices, et cetera. I think that's a real interesting story from a strategic perspective, where the vast majority of investors are totally unprepared for that, right? They're basically prepared for the next 40 years to be the same as the last 40 years.
Yep.
And it's very possible we see a totally different environment where there's persistent pressure, upward pressure on inflation, and higher levels of risk in the economy than what people saw before. So from a strategic perspective, it really draws you away from sort of traditional 60-40 to much more balanced, particularly holding diversified commodities. I think also in that context, the delinking of global capital markets will likely cause those outside of the dollar market in particular to look for other monetary assets. I'm kind of an old school macro guy, so my mind, of course, gets drawn quickly to gold, and the demand basically from non-U.S. entities to hold gold as a way to hedge, dollar exposures and that withdrawal of capital. People who are into the world of alternative money might also argue, and reasonably argue, that maybe Bitcoin is a reasonable alternative as well, and might cause might be an area where folks who may not have access to dollars might choose that as a currency to either save or transact in. I don't have a particularly strong view on Bitcoin one way or the other, but I think there's some reasonable logic related to that would align with this more secular view of just trying.
Well, in a secularly inflationary world, investing in something that sort of holds its purchasing power as an inflation hedge makes sense.
That's right, and finding other money other than dollars if you're locked out of the dollar system, either as a saver in a state level saver like a sovereign wealth fund or central bank, or as an individual saver, where having dollars stuffed in your mattress if you're in Beijing may not be as effective in the next 20 years as it was, in the previous period. And so I think that's kind of an interesting, basically an interesting sort of strategic situation for many portfolios that are just not very well prepared. What happens if inflation is not at 2% or 1% for the next 20 years because of all the dynamics we described? What if it's at 3 or 4%? That's a very different environment than most people have saved in.
Right.
So that's, I think that's probably the most interesting strategic story that's going on.
Great. Sorry to interrupt, but just to maybe add so you can riff on this. But a higher inflationary world generally means a higher interest rate world, correct? I mean, interest rates are basically a function of inflation and inflation expectations. So higher cost of capital. I just want to put that into the mix because you said it may be a very different next 40 years than we've been used to for the past 40. And the past 40 was disinflationary and just, an escalator down in bond yields. So that could be a very different world going forward.
That's right. I mean, I think whether or not inflation remains elevated or ends up being elevated meaningfully relative to what we experienced is really a choice by the central bank. The question is not whether or not there will be inflation pressures as this plays out. There will be inflation pressures that will emerge as a function of this. The question is, how much inflation is going to be taken versus how much is the Fed and the central bank going to and other central banks going to basically keep a lid on that inflation by keeping interest rates high and suppressing demand in that context. And so you don't know which one it'll be. So you kind of want to be positioned for both of them. I think one of the key things that, it's a particularly large flip from the era of zero interest rates and unlimited money supply that many businesses and investment strategies, frankly, have been built on. So if you're a venture capitalist or a private equity manager, like, it has been a great 15 years, but it may well be quite a challenging next 15, which we're just at the start of, if you're reliant on, zero interest rates and unlimited liquidity in an environment where we have, this amount of infrastructure rebuilding and elevated inflationary pressures.
Okay. All right. So, those are sort of secular outlooks. And if I took decent notes, you think sort of inflation hedges make sense to have in there, especially for people in countries that are exposed to dollar risk. I guess one question on this, folks like Jeremy Grantham, highly respected investors, he for a while, and I think he still continues to say, hey, lots of opportunity in emerging markets. Don't forget about those guys. And of course, price and value are two different things. But my guess is you would say emerging markets are not going to perform as well as some might think in the type of, should we go down this increasingly deteriorating globalization path?
Well, I think it matters a lot. There are no emerging markets. There are countries and there are particular economic conditions, and so the path that we've described actually could be very, very, very positive for a country like Brazil, right? With strong demographics and geographic proximity, and relatively well managed actually macroeconomic conditions and elevated interest rates that could come down, and that's a combination of things that actually could be very positive for a country like that. Whereas the story for say Philippines or Vietnam, which may be locked out, may be forced to, instead of being sort of a globally integrated economy, be a China bloc integrated economy, it could be quite poor for them. So matters a lot who we're talking about in that context.
Got it. Okay. So take a very active approach to it, and it really matters what team you're on and what the prospects of that team have. Okay, great clarification. All right. So if we can bring in our beam from years to decades out to 2024, and let's say at least the parts of 2024 and your headlights feel comfortable talking about here. What are you looking at right now? Because the vibe I got from you sort of earlier is feel pretty good in the near term, right? So is it sort of game on for everything, or are you worried at all about how far and how fast stocks have gone, or any other assets?
Well, I think one of the fun things about being a macro investor is you can pick the trades that you want to pick and not pick and not trade the things you don't want to pick. And that's an important thing. You don't have to trade every market. You don't have to think about every market. You just want to find the best opportunities. And so I think coming into the year, the best opportunity seemed relatively clear that we were probably not going to have 7 cuts that were priced in to the US. And probably there was going to be pressure on bond yields to rise and for stocks to outperform bonds. Now, the reality is in the last 6 weeks, pricing has changed a lot. Just before we got on here, I was looking at it, and now we have 3 cuts priced in for 24, not 7 cuts priced in. That's a heck of a move, particularly in 8 weeks. That's a heck of a move to have seen over that time frame. And so now interest rate policy on the short end is kind of reasonable. Maybe there'll be less than 3 cuts because the economy is stronger and inflation is a little higher. But you don't want to pick trades that are, the difference between 3 cuts and 2 cuts. Who cares? No one has that level of precision, right? The difference is between 7 and 3 and 2, right? That's what you want to trade. And so right now, when I look across the overall financial markets, you have a strong economy, you have elevated inflation pressures, you have a Fed that probably is going to be a little more cautious than what many people had expected. The place, and I should add, and you have large fiscal supply that's coming into the market that's going to pick up by 50% on a net issuance basis in the second quarter of the year. And so the real question is why are bonds, can bonds continue to be priced in a way where, there's essentially a 0 term premium on the long end of the bond market, given that set of macroeconomic conditions? It seems unlikely we're going to see that. And so yield curve steepening seems like one of the most compelling dynamics right now. Right now we have an inverted yield curve, and we still have an inverted yield curve. And so seeing a shift to a steeper yield curve environment seems compelling, given what's happening with the macroeconomy, and also what's happening with the overall flows dynamics. So that's really what I'd center on. And that impact on stocks.
I just want to make sure the viewers are following you here.
Yeah.
So when you talk about a steepening of the yield curve, I believe you're talking about the long end of the curve catching up to where short-term rates are right now versus the other way around, right?
Exactly.
Which means that bond prices will come down. Bond prices
will come down, yields will go up. That's exactly right. is that a lot of the tightening, I mean, essentially a lot of the tightening that we've seen so far has been really the short end dragging up the long end, rather than the long end reflecting the underlying strength in the economy, the inflationary pressures, and the bond supply. And so, that's the sort of thing that can continue for a period of time. But it's almost like each day the recession doesn't come, the long bond holders look at themselves and say, ooh, this may not be the right trade here. I'm not sure I necessarily want to hold this much duration. I might not want to hold as many bonds as I'm holding right now, just as the supply of the bonds coming into the market is rising substantially. And so that really looks like the best opportunity when I scan across the markets and look at all the different things. Now, most people don't care about trading yield curves or short rates. They probably mostly care about equities. And what I'd say there is, we've gotten a heck of a run of stocks, in particular relative to their performance versus bonds. We've got a heck of a run on that. Mm-hmm. And the economy is strong, but it's going to be tough to meet the level of expectations, particularly in earnings that exist in the market, whether it's in the Mag 7, but also, S&P 493 is expected to have, higher double digit year-over-year earnings by the end of the fourth quarter. It's going to be tough. That's going to be tough. That's going to be.
I agree.
It's not impossible, but it's going to be tough. And so I think we're transitioning, and you just even see it in the market. You kind of that those bond yields rising are kind of putting a bit of a lid on what's going on with stock price appreciation. And so that dynamic, that interplay might be, will probably add up to a more contained equity market environment on a forward-looking basis than what we've seen over the course of the last, 3 or 4 months. I mean, it's been a heck of a ride in the last 3 or 4 months. With any context, it's been one of the best stock market, 3 or 4 months that has ever existed, outside of bounces at bottoms. So it would make sense to have, a bit of a pause on a forward-looking basis, particularly if we see a yield rise that comes with it.
Okay. And I'm just curious, how are you playing that? Are you actually beginning to sell here and lock in these gains? Are you just putting hedges in case there's a correction? Are you making big sector rotational shifts? Like, how are you dealing with that reality of, hey, we've had a nice surprise on the upside here. Yep. What are we going to do about that going forward?
Well, I think that still the best trade if you're going to hold equity risk is stocks versus bonds. And so the thing that I see on that is cutting back the strength of that position, which has been a heck of a position in terms of trading over the course of the last, 12 weeks or something like that, and instead shifting, if you agree that the U.S. economy is likely to be in pretty good shape, then you're better off betting it on yield curve steepening than you are on betting it on stocks outright or stocks versus bonds, given where stocks are. If we get another couple quarters of 3% GDP growth, bond yields are going to move up a fair amount relative to short rates, and that'll be a pretty good trade. So it's always, whenever you're trading markets, it's always a question of where is the best disconnect between what's likely to transpire in the macroeconomy and what the markets are pricing, and that's where the best disconnect exists today.
All right. This is great. So, Bob, thank you so much for coming on here. I just have a couple quick last questions for you, and we'll wrap it up here. But I do want to say I have, got a lot of people that come on this channel. We do 4 interviews a week, so you can imagine we produce a fair amount of these discussions over time. And I would say that you are more optimistic than the average. And people are always asking me, "Hey, you should get more bulls on the program. Why do you interview all these bearish people?" And I don't recruit people for bullishness or bearishness. I just recruit people who are data driven in their framework and can have a data driven rationale for why they see what they see. And for whatever reasons, the majority recently have been more on the pessimistic side. So it's really nice to hear the other side of the argument and explained so clearly and well here. And then of course viewers can pick and choose of which argument they think personally is more compelling. First off, would you call yourself bullish right now? Again, I don't want to put a label on you if you feel like it's an unfair one, but I think relative to the people who've been on this channel recently, I would describe you as such.
Yeah, I wrote at the beginning of the year, my view was instead of, this idea of higher for longer, my thought was stronger for longer. And so you call me an economic bull, and then that, what that means for asset prices, place it, that means I'm a bond bear as a function of that, right? A macro guy doesn't think about, bullish and bearish as only one particular asset, right? You think about all the assets, and bullish stocks versus bonds, bearish bonds, bearish short rates, all of those things are all around the central idea that, the strength of the economy is not sufficiently reflected across asset markets at this point.
Okay, great. And I should have qualified. I would have been an economic bull, but yes. So okay, great.
An economic bull.
Great, great. Well, the door is open here to come back on anytime in the future you'd like to, when you're seeing anything, positive or negatively on the horizon that is evolving the way that you think. It's really nice to have people in both camps here that, again, aren't doing it from a place of dogma. They're just doing it from a place of looking at the data and then making their case. All right, so two last questions for you. First one, very important. For folks that have really enjoyed this discussion and would like to follow you in your work, where should they go?
Yeah, I'm very active on Twitter or X or whatever the heck you call it these days. I still go to twitter.com every time I write a tweet every morning.
Yeah.
So it's at Bobby Unlimited. I'm very active there, just on the play-by-play of what's going on in the macro markets. And then, if you don't like to read tweets and like videos, I also have last couple months started a YouTube channel, also at Bobby Unlimited, with clips from various appearances. And then for those of you more into the finance industry dynamics, I use LinkedIn to talk a little bit more about some of the dynamics that are going on in the asset management business as well, which you can find me under my name.
Awesome, fantastic. And when I edit this, Bob, I'll put up the URLs to those on the screen so folks know exactly where to go. Folks, we'll have them listed in the description below the video too, if you want one-click access to them. Okay, I'm going to ask you the last question in just a second. I got a little bit of housekeeping to do beforehand, but just to give you a heads up, it's that we've been talking about all sorts of macro market money related topics here so far. What's one non-money related investment that you would encourage people to consider adopting in their lives? And I'll give you 30 seconds to think about that while I just do our housekeeping here. First off, folks, if you really enjoyed having Bob on, would like to have him come back on in the future again, when he's got the next big insight from what he sees through his forward telescope there. Please let him know that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Want to remind folks that the Thoughtful Money Spring Conference is coming up very quickly now, so less than a month away. The lowest early bird price discount that we're offering for tickets is going to expire soon. So if you're thinking about coming to the conference, lock that in by registering now. And a reminder, if you're a premium subscriber to our Substack, you'll get an additional $15 off of that lowest early bird price. And if you want to game the system, it only costs $15 a month to become a subscriber. Feel free to sign up for the $15, use it to save the $50, pocket the $35. I want you to get the best deal you can get. Lastly, Bob's given us a lot of great things here to think about. A lot of different ways to look at what's going on right now for the average investor. I know it can be kind of overwhelming, which is why I recommend that most viewers work with a good financial advisor, work under the guidance of a good financial advisor, but importantly, one who takes into account all the macro issues that we talk about in this channel, including the ones that Bob and I talked about here. And when you add those series of requirements together, the universe of financial advisors really gets pretty small. So if you've got a good one who's doing well for you, well by you for that, great, stick with them. They are worth their weight in gold. If you don't, though, you'd like a second opinion from one who does, consider talking to one of the ones that's endorsed by Thoughtful Money. To do that, just go to thoughtfulmoney.com, fill out the very short form there, have one of those free consultations. They don't cost anything. There's no commitment to work with these guys. It's just a free public service they offer to help people position prudently today in advance of what may be likely to happen down the road. All right, Bob, thanks for your patience there. We're now back to you. What's one non-monetary related investment you think is worthwhile considering?
One of the things that's really I think been compelling in the course of my life is walking, which is this is going to be feels like a pretty low key idea. But you'd be surprised at the magnitude of the benefits that come with walking, both intellectual benefits in terms of, creativity and thinking through problems. Some of the best work that I do and thoughts that I come up with occur on the morning walk with the dog or a quiet walk with a colleague. And also, I think one of the things that's even more compelling about it is, there's so many people so focused on, various forms of exercise. There's no meaningful health difference between similar distance walking and things like running and other cardio outcomes. And actually, one of the things that came out in the middle of COVID, which didn't get nearly as much press as probably it deserved, is 12,000 steps a day reduces all-cause mortality by 60% once you account for all the typical issues like smoking and diet and other exercise and other health conditions. Which, like, if I told you what's one thing you can do to reduce your probability of death by 2/3, like, would you do it? You probably should. 12,000 steps, do it.
I'm so glad you brought that up. I completely agree, and more important than me agreeing with you are guys like Mark Sisson and Peter Attia, who are some of the greats now in the functional health space. Mark Sisson's been doing this for much of his career. He's in his 70s now, still looks amazing. And he was a big runner. That was sort of his on-road to health, to fitness. And I heard him interviewed recently, and they sort of asked him, "Hey, what are some big changes you may have made as your thinking has evolved?" And the top of his list was walking. And he said, "I kind of looked down on it as a runner, but as I got older and I started walking more, and I actually saw the benefits of the two." He said, "I think that walking is it's the perfect exercise for humans." He said, "It's the movement that our bodies are most evolutionarily adapted for, and the health benefits of it are great." And there's a lot of data out there where folks, can go see the proof of that on their own. But the thing you also mentioned, I just want to underscore, is the mental health benefits and sort of the expansive thinking. And I presume what you're saying when you're walking, that's walking in a disconnected state from digital distractions, right?
Oh, yeah, for sure. That's actually, having a dog is the best thing for a walking environment, because you have to pay attention to your dog the whole time.
Well, I'd also just say having a dog is the best thing. They are the best mental health boost in the world, because having somebody that treats you like you're the most important person in the universe,
That's right,
come home is great. All right, well, look, we'll have to wrap it up there, but wonderful answers all across the board, Bob. Really appreciate your time here. Thanks so much for coming on the channel. Everybody else, thanks so much for watching.